And welcome back to the Prescribing Prosperity Podcast with your hosts, John and Alex Soutsos. Gentlemen, how you doing?
Hi, Bill. We're living in interesting times.
Oh, yes, we are, aren't we? Aren't we, though? And in fact, that's what today's podcast is going to be about. The joy of living in interesting times, because stock markets and markets in general don't like interesting times, do they, John?
No, they don't. And we saw evidence of that last week where they declined a bit. You know, what's interesting, Bill, is the magnitude of the decline in the U.S. market last week was not really all that dramatic.
Right.
The S&P was down 2%. What was more interesting, and we know that the S&P 500 index is a market cap weighted index, which means that the top 10 stocks have a disproportionate impact on daily price movements. So 2% decline means the Big 10 companies, which incorporate the Magnificent Seven, really didn't move all that much. I mean, a 2% decline is not that big a deal. But the thing is, those stocks really haven't been doing anything because they've been weakening throughout the tail end of the fourth quarter of last year and throughout the early part of 2026. So they had already weakened. And so that 2% was just someone tying a bow on that box. What has been occurring under the surface is the other 493 stocks have picked up the baton in this race, and they've been moving up in Q1 of 2026 and to the tail end of Q4 2025. And so it is those other companies that really took a hit. And so the equal weighted version of the S&P 500 index declined by 3.3% last week, which is more significant. And then if you start looking at small caps and mid caps, which have been on a pretty nice run, they had declines in the magnitude of 5% and a bit.
Oh, before you continue on your long-winded diatribe here, I think it's important that we actually provide some context for people as to what time horizon we're speaking about here, because by the time this is released next week, they are not going to know what time period we're referring to. And so this is the week following the launch of the conflict in Iran, of Operation Epic Fury, which was launched on February the 28th. And so we're speaking about the week that was ended March 6th of 2026.
Yeah, that's correct. So for context, that's the week, and things have settled down now this week. But clearly there is no strength in the market, or when I say the market, there's no strength in the S&P 500 index, which is market cap weighted. And so there's no strength this week in that market. But
why is it, John? I mean, there is a simple argument that we've had a tremendous run up and the markets, were delayed in getting some sort of correction. This is overdue and this had to happen.
There's two ways. So there's two ways the market can correct. It can go down,
right, or
it can enter a period of chop, meaning up and down, but net sideways movement. And that's essentially, if you look at the S&P 500, that's what's been going on since the end of October. So through all of November, December, January, February, you had this up and down. The market was in a 4% trading range, from about 6,700 to 7,000 on the S&P 500. And then you had the military engagement in Iran. And that was just a convenient excuse for people who were already nervous to go ahead and sell the companies that had been doing well. So within our portfolio, we've had a tremendous run so far this year. Up until the end of February, our portfolio was up somewhere in the range of 15 to 17% in US dollars. So
15.83, or was it year to date here? I had it. It was up over 15%.
So somewhere between 15 and 16% in the first 2 months of the year compared to the S&P, which was essentially zero. And so we clearly had rotated the portfolio into the portion of the stock market, which the portion of the stock market that has done something this year is essentially about 60% of the S&P 500. So we rotated capital into those companies, and they had done very well. But what happens is when you choose high quality businesses, as we do for our portfolio, and there's some uncertainty in the market, they're not going to sell off the stocks that have already been sold off because they've already been sold off. So they're going to sell off some of the higher quality names. And so our portfolio suffered last week because of the fact that we hold high quality names. That being said, it wasn't a fatal blow. It was a flesh wound. And we're still way ahead of the market for 2026. As of the close of business yesterday, we're up over 10%. The market's down about 1 or so. So we're ahead 11% year to date, which I think is pretty good. And based on what's going on in the market as we speak, with 40 minutes to go on today's trading day, March 11th, we're ahead by about 0.5% of the market again. So we will continue to build on that.
Well, here's the bigger question for me, but I think this is what probably a lot of your listeners are wondering as well. Is we know that markets don't like uncertainty, and the Iran engagement is definitely creating uncertainty in the markets. But for how long do you see this going on? I mean, does this and who does it impact the most?
Oh, well, that's a loaded question. Who does it impact the most? So let's begin with how long it's going to go on. I don't know how long it's going to go on. The U.S. president has given us a timeline of 4 to 6 weeks. I think whatever your feelings about the U.S. president, good or bad, one thing that's been very clear since he took office 14 months ago is he has pretty much stuck to his script, and he has made certain promises, and he's fulfilled those promises. He said, I don't know if I think everyone here should remember this, but a year ago, we were talking tariffs. It is now mid-March. A year ago, we knew tariffs were about to hit at the beginning of April. The U.S. administration was talking about them. They had yet to implement. And the U.S. administration said that what you're going to see at the beginning will be the highest level, and they're going to go down from there. And the first one to the table to negotiate gets the best deal. And I think as soon as the U.S. president opened his mouth, the people who don't like him just plugged their ears and didn't hear anything he said after that. And so there was a lot of uncertainty, and the market tanked. But I don't like getting my news from the media for obvious reasons. It's very distorted and biased. So I tend to listen to a bunch of speeches, which I know most people aren't going to take the time to listen to. But I listen to speeches by the politicians, and I listen very carefully. And to me, there was a clear timeline last year with a discussion on tariffs as to how long they'd likely, or the magnitude of their impact, and how long the negotiation was going to last. I adjusted my portfolio accordingly. And I've been doing the same this year as I've been adjusting my portfolio accordingly. I did not panic after last week's activity, even though our portfolio took a setback. But you can't manage by the news headlines. That is irrational. It is not a real strategy for investing. Our strategy is focused on investing high quality businesses in various sectors that are demonstrating strength, and then making adjustments along the way. And knowing that this conflict is going to be short-lived, as it was announced.
Hopefully, fingers crossed, it's going to be short-lived.
Yeah, and I don't think it's going to be a long affair. We saw how quickly things unfolded in Venezuela, and obviously this is not an exact similar situation, but the indication is that there's a finite timeline where the majority of the objectives are trying to be met. Yeah. And I'm not passing judgment, good, bad, or indifferent. This is not a political discussion. This is an investment discussion.
Mm-hmm. Well, hold on.
So
let's pause there for a second, and let's take a step further back as to, because in order to understand how long this is going to last, you first need to understand why this is happening. Similar to the tariff discussion, during his campaign and in the immediate aftermath of his campaign, President Trump discussed that they were not happy with the state of affairs when it came to the ongoing negotiations with Iran.
Right.
They did not like the previous administration's approach towards the increase in the ballistic missile program and the lack of progress that was made in terms of constraining their development of that ballistic missile program, as well as the development of nuclear enrichment that was occurring, and in addition to the proxy terrorist financing that was occurring throughout the Middle East and into North America as well, which is a problem that, I think some people have a tendency to look at stuff like this and say, it doesn't involve me in North America, and therefore they shouldn't be getting involved. And the problem is that it has involved people in North America, and that's why they took steps to take corrective actions. They tried to negotiate, and then when the negotiations were fruitless, they took further steps to then bring about the ultimate outcome that was their long-term objective. And I think what
listen, it's what you said is all good background information, but I'm not here to litigate the merits or
no, but it's important to discuss so that we're providing our perspective on what is going on. Yeah. And in order to have that perspective, you first need to have the context for what is going on and why it is occurring. And so, because the objective is to try and limit the armament of the Iranian state and the theocratic leadership that is involved.
I think the objective is very reasonably stated, and it's been stated very accurately by the president himself. The goal is regime change. Mm-hmm. Now, what that looks like, we don't know. Frankly, at this point, no one does. I'm sure that there are people who have designs in. There are some really great podcasts out there talking about the risk and who might and who will. But the simple objective is regime change in Iran.
Correct.
Because whatever the objectives are, whatever the rationale is, I understand it. I know you guys want to share some perspective with the audience out there. But in terms of the investment portfolio that we manage, it is our role.
We're not there yet. We're not at the investment aspect. You keep jumping ahead here. Let's follow a linear trajectory.
But just to follow up that thought for 1 second. So we know what the objective is. My question to both of you is, it's easy to state the objective: we want regime change. Mm-hmm. Manifesting that regime change, John and Alex, I would think, influences your investment decisions, because there's a great deal of risk. There's a gamble in there, whatever the outcome. I don't want to get into the politics of it.
That's fine.
So, the most immediate thing that I can see and we saw it really fast when there were reports that Israeli jets had struck a oil refinery. Mm-hmm. Oil prices went way up. Oil prices mean higher costs, no matter where you look. So, John, can we maybe go right in on that for a second and just talk about your reaction to possible spikes in energy prices?
So historically, whenever you've had a spike in oil prices due to military conflicts or disruptions in the supply of oil for other reasons, the impact is dependent on the duration of the disruption and the duration of the cost elevation. So given the stated timeline by the U.S. administration on this intervention, 4 to 6 weeks, and given their objective to maintain traffic through the Strait of Hormuz in some manner, I don't think oil prices will remain elevated for an extended period. They might remain elevated for a month. So that doesn't really materially impact the economy, at least not the U.S. economy. First of all, the U.S. is more or less self-reliant in oil. They produce somewhere in the range of 90% of their own consumption, and the rest is traded for with Canada and most recently with Venezuela. So I'm not factoring into my decision making a period of oil prices remaining elevated for an extended period. That being said, as a hedge, I have introduced one energy company in the model portfolio last week, but that's just insurance, basically, to provide some ballast to the portfolio. And if I see that this situation will be perpetuated beyond 4 to 6 weeks. And then I might have to make additional changes to the portfolio to reflect that potentiality. But I don't see this going beyond the stated timeline. I mean, really, it's not a fair fight. I mean, realistically, the U.S. is doing, they have the upper hand. They're going to win this. It's just a matter of time, whether that time is 5 weeks, 6 weeks, or 8 weeks. I don't know, but I'm not factoring in an extended period of elevated oil prices, which means I'm not factoring in concern for a recession in the U.S. economy. And, different story if you're China and you're getting, 90% of your oil supply from Iran. Or I should say, I shouldn't say that. But
no, it is.
They're getting
It is over 90. Well, they get 90% of it from through the Strait of Hormuz, and it's not just from Iran. Yeah, it's from all those countries. The UAE. Yeah. It's from the Iraq. There's a whole bunch of producers. Kuwait is in that region as well, and so the supply that goes through there is China's main artery of energy.
It's China and the remaining Asian countries who are getting their supply of oil from that part of the world. Yeah. And so it's going to be more impactful on those economies than it will be if it's sustained on those economies than it will be on the U.S. Economy.
Okay.
So to answer your question, Bill.
Yeah, I think it's important to note, like you said, so China is the largest importer of oil in the world, and 90% of their oil comes from that region. So they are significantly at risk, whether it's on a short-term or a long-term basis. The other countries, as you correctly mentioned, are the Asian countries: Japan, South Korea, India, Taiwan. They are particularly vulnerable. One of the other ones, which is a little ironic, is Germany. Germany is also heavily reliant upon energy from that area because because Germany did away with their own energy program, and so as a result, you have a lot of countries in the region who are short-term vulnerable to the prices and fluctuation and the supply of oil. But as my dad correctly mentioned, the United States is the largest producer of oil in the world. They produce almost 22 billion barrels per day of oil. They produce 22%. To put that into context, that's 22% of the world's daily oil production comes out of the United States. So for the United States, it's not, which is the market that we primarily trade in, it is not going to have a material impact other than to potentially increase the price, the pass-along price of goods that are imported from outside the United States, and the cost of transporting goods and goods throughout the country, because the oil prices will be elevated. Even though the United States is self-reliant, oil prices reflect the global supply of oil, and so when the global supply contracts by, about roughly 20% is what goes through the Strait of Hormuz on a daily basis. When oil supply, is constrained by about 20%, regardless of how self-sufficient the United States is, that will be reflected to a certain extent in the prices at the pump and the prices that suppliers and transporters in the country face. And so there might be some margin compression that occurs on a temporary basis, but it is not likely, as my dad said, to be anything that is going to be material on a long-term basis.
The subject of geopolitics comes up often with my clients.
I'm sure it does.
This is my 40th year in the business, and there's been all sorts of geopolitical events over the course of 4 decades that I've seen, and I've seen the impact on the markets. And the historical evidence is that geopolitics are always disruptive for a short time. They never have a long-term impact on the capital markets. The capital markets over time follow corporate earnings growth. And corporate earnings growth has been on a certain trajectory, on average, somewhere between 8 and 10% growth rate over 70 years. So as long as that doesn't change, then the expectation is that capital markets will adjust to short-term impediments and will continue on that trajectory that's been established over the last 70 years. So I'm not concerned about the viability of our portfolio to succeed, regardless of whether this is a 4-week engagement or an 8-week engagement.
And the other thing to mention too is, and something that I don't think is being discussed enough in the media right now, which is the potential steps that can be taken to mitigate some of the impact of the closure of the Strait of Hormuz. Let's set aside the potential military intervention to ensure
Well,
that it is
we
reopened and
we
operating.
already got military intervention because we got word today out of the region the day we're taping this
Yeah.
that the United States had sunk
Yeah.
a number of mine-laying ships, so that the concern about that strait being mined is greatly relieved. So that is, let's call it off the table for the time being.
Exactly. So you have that mitigating factor. You also have the mitigating factor that countries now, as a result of the oil embargo that occurred in the 1970s, have strategic reserves in place of oil that can be released onto the market in order to increase supply and therefore lower prices. The other potential alleviation could be a more of an impact or more of a role for Russia to play in the world's oil supply. So Russia has been facing heavy sanctions ever since their dalliance into the Ukraine and the conflict that is occurring over there. And there have been heavy restrictions placed on the distribution of their oil.
Mm-hmm.
Should the powers that be see it necessary, they could theoretically temporarily alleviate some of those restrictions and sanctions that are being placed on Russia right now, allow them to increase their sell some of their supply on the open market, which would again further dampen prices. And so there are things that are being discussed and events that are unfolding in real time, as you just mentioned, Bill, with the sinking of those mine-laying ships this morning, that are occurring, that are going to materially impact things between now and the time this podcast comes out in a week from now. And so I think for people to get too wrapped up into what is the long-term impacts and how is this going to play out in the market, it's difficult to say, and realistically, it's probably not going to be a material factor on a long-term basis.
Let's not forget OPEC Plus, who also have the ability to increase their exports.
And they did today. I believe they released a significant amount of supply into the market. So
So as far as our portfolio is concerned, yes, I'm paying attention to what's going on in the current conflict in Iran. Yes, I've made some adjustments, but I'm not completely changing everything because everything has not changed.
Yeah,
this is a temporary situation. I see it as a temporary situation, and that's how I'm dealing with it.
And just to give, sorry, Bill, I just want to provide a quick number check here. So the peak price increase when this all initially unfolded was in the neighborhood of 52% to 64% on the price of Brent and West Texas Instrument price of oil. Intermediate. Sorry, did I say instrument? I'm thinking of the calculators. The West Texas Intermediate, and so you have it surged to $120 per barrel at one point on an intraday basis. It is now back into the $85 per barrel range, which has us at about a 16% increase from what it was the day before this conflict occurred. And so already, as we've seen in a very short period, the price has spiked, and now they're starting to normalize again as more information comes out and it's digested into the markets.
For perspective, when Russia invaded Ukraine, oil spiked up to 143 a barrel, and so we didn't get anywhere near that. And that conflict's been going on for over 4 years now. So I mean, we could there's a lot of geopolitical discussions. We could take this down, go down that path, but we're not going to do that. We want to focus in on the economics of what's going on and how it's impacting our portfolio. So with that, Bill, what other questions do you have about how we're dealing with this current situation?
I want to change to something else because you talked about economics, and it immediately drew my attention back to the inflation rate that was reported this morning in the United States at 2.4%. So, we're not looking at the massive, horrible inflation numbers that everybody told us we were going to get when Trump threw his tariffs into the market, and there was the predictions of the imminent demise of the world economy and the United States economy. And instead, you now have people saying, hey, inflation appears to be maybe somewhat under control, and we are going to be getting a new head of the Fed here in the United States. So I'm wondering, John, to what extent you're looking at those developments and factoring them into your portfolio.
That I'm definitely monitoring those developments very carefully and very closely on the subject of the inflationary impact of tariffs. A couple of things. John Butters of FactSet, in his most recent release, indicated that when they assessed corporate earnings releases over the last quarter, the number of mentions of tariff inflation had dropped off a cliff. So this was obviously a big concern through 2025.
Yes.
But companies are not putting the same amount of attention on this subject as they were through 2025. So it's becoming less and less of an issue amongst C-suite executives in the large U.S. companies. Now, 1 year ago, while this the discussion about tariffs and the impact on inflation, I said very clearly in my weekly newsletter that tariffs are not an inflationary item, and I explained tariffs are a friction in economic trade, and anything that is a friction actually has a disinflationary impact. And that's not what the mainstream media is telling everyone out there, or what they told everyone out there. But because I had that understanding as someone who specializes in economics from my university days, because I knew that, and I didn't worry about inflation. I didn't worry about an economic recession. And so I adjusted my portfolio accordingly a year ago. And today, Bill, I'm happy to report that going back 12 months, our portfolio in US dollars is up over 50% compared to about 20% for the US stock market.
Actually, you're being slightly modest because what the heck? We'll make it a little adjusted. Over 51%. I can't remember. I don't remember the exact percentage
50,
there.
I think it was 53, but anyway, the point is this. If you understand economics as we do, you don't get caught up in this, and all I tend to hear in the media is nonsense. It's just political bias constantly. One day after another, 1 minute after the other, it's constant political bias. They hate the U.S. president. They want to make him appear in as bad a light as possible. And so it's Trump derangement syndrome. I really don't care about that stuff. Kevin O'Leary, a famous Canadian and American businessman, says, that's background noise. I focus on the signal. Okay, so I'm looking at the signal, and the signal is this. Tariffs have not been, and I said it a year ago before the great tariff announcement at the beginning of April. I said it in my newsletter. It's documented. People can look it up. Tariffs are not inflationary. There will be no recession. And so with that mindset, I made adjustments accordingly in my model portfolio, and we have eviscerated the underlying index in terms of performance. And for that matter, we've eviscerated our competition. There's no one in North America amongst major mutual fund organizations or ETF issuers who have performed at our level. Not even hedge funds have performed at our level. So I'm not concerned about that. Now, you mentioned about a change in the, one more thing on the subject of inflation. The government, the US government, continues to rely on these antiquated calculations for inflation, which are always on a time lag and really are not giving us up-to-date data. We rely on Trueflation, which is a private sector organization that provides up to the second information about inflation. They get live feeds from, I don't know how many, 18 million data points, or I don't remember what number they quoted, but I rely on Trueflation. And Trueflation has been consistently going down ahead of the government stated inflation data. And I think the Trueflation data, which today, or when I wrote my this week's newsletter, was 0.86.
Today it's 1.08. 1.08%.
Let's call it for the sake of discussion, it's about 1%.
Yeah.
So I think this is the trajectory of the government data. Eventually, it's going to get there, but right now it's not there. It's still on a time lag. But 1% is the actual real inflation rate because we can rely on the private sector to give us the real goods. Now, on the subject of a changing of the Federal Reserve chairman.
Yeah.
So as we all know, the current chairman's Jerome Powell, his current tenure will expire in May, and he is being replaced by a gentleman named Kevin Warsh, who's quite an accomplished individual, and he sat on the Federal Reserve Board previously, not as chairman, but in the capacity as one of the members. Now, Kevin Warsh, unlike the current membership of the Federal Reserve, is not a Keynesian. For people who don't know the history of economics, John Maynard Keynes believed that government should intervene when the private sector slows down to stimulate the economy. What proponents of John Keynes forgot is they didn't read the second half of his essay, which is once the economy right-sizes itself, that intervention should be removed. But governments made the decision never to remove that stimulus, and so governments just continue to grow and bloat themselves to the point where they're damaging economic activity through their interventions. So it's not that John Keynes was wrong necessarily; it's that his recommendations have not been followed accordingly. But there's this belief based on Keynesian economics that when the economy grows too rapidly, there's a shortage of the factors of production, and therefore you get inflationary forces. And so the central bank must raise interest rates to slow down those inflationary forces. Yeah. And so this is why government after government in the United States and in Canada and in Western Europe historically have stimulated the economy through debt. Well, they've taxed people to death, and then when they run out of tax money, they borrow like crazy and spend. And so they think the only way to stimulate the economy is through government intervention, not realizing that the private sector can manage on its own. Thank you very much. That's how we became a prosperous society over the last 200 years. But they believe that the more the economy grows, the more it's going to create inflation, and therefore the central bank has to raise interest rates, which is a bad thing for people who are borrowing money. Kevin Warsh is not of that mindset. He's what we call a supply side economist, which is consistent with the economic foundations of the current U.S. administration. They believe in supply side economics, and for those people who are not familiar with that terminology, it means that if you expand the supply of goods and services sufficiently, you're not going to have prices going up. The increased demand will be absorbed by increased supply. And so that's effectively what this current U.S. administration has been working on. And that's why they talked about expanding the energy supply, because by expanding the energy supply, the cost of energy throughout the economy goes down, which is a disinflationary impact. And as we all know, energy is a factor in all aspects of our economy. It feeds through transportation and the production of materials and fabrics and et cetera. So and the history has provided the evidence. And I don't care what side of the political spectrum you're on. We deal with a lot of doctors, and they say, we rely on evidence-based medicine. Well, the economics-based evidence shows that prosperity in an economy is founded on inexpensive energy. And that is what the current U.S. administration is endeavoring to do, is to create inexpensive energy. Yeah. And we're seeing that is having a very positive effect on the economy. There's also this one big beautiful bill that's been often spoken about in the financial press, which was passed into law July 1 last year, but it only came into effect for the most part January 1st of this year. And so as we speak, there are families in the United States are getting tax refund checks that are roughly 33% higher than they have been historically. Now, that doesn't, that's a big number. And the absolute numbers might be the difference between $2,500 and $3,800, which again, doesn't sound like a lot of money, but for a good portion of the American population, getting an extra $1,300 in your pocket in one lump sum is going to be, it's going to be very beneficial. It's going to stimulate economic activity because people aren't going to take that money and stick it in the bank. They're going to take that money, they're going to spend it. And that's going to stimulate the economy. So there's that economic stimulus that's going to boost GDP growth. That's going to boost corporate profitability, increase the valuations of capital markets and stocks. And so this is all a good thing. Now, Kevin Warsh, being a supply side economist, also doesn't believe that the Federal Reserve should be holding assets as it has been doing since the 2008 great financial crisis. It has purchased mortgage-backed securities and put it on the Federal Reserve's balance sheet, which the original iteration of the Federal Reserve in 1913 was never authorized to do and was never even dreamt of at that point. And so he's trying to return the Fed to its traditional roots. And so as a result, he's going to be running off that balance sheet, which is really it's a shrinkage of the money supply. And when you shrink the money supply, that tends to slow down the economy, but he will offset that by cutting interest rates. And so you're going to get lower interest rates when the new Fed chairman comes in. The timeline is uncertain, whether it'll be immediate or whatever, but I think it'll be immediate. I think that's going. I'm preparing for that. You know, when you have a reduction in the money supply, cash flow for corporations becomes very critical. So companies who are very levered are going to have a bit more difficulty. But if you're a company who has free cash flow, you're going to do much better in that environment. And so in the course of managing the portfolio, I'm focusing in on those companies that have high free cash flows.
All right. Very good. So it sounds like you're looking at it and saying steady as she goes. That would seem to be your approach at the moment. Don't panic. Remain calm. Make adjustments you're making adjustments to your portfolio management in a cautious manner. And all is going to, hopefully, knock on wood, it will pass. And interesting times will go away.
I think it was Winston Churchill who said, keep calm and carry on. Or some Brit during the Second World War.
Yeah, exactly.
I think it was Winston Churchill.
I don't know if that
keep calm and carry on.
Keep calm and carry on.
And then that's exactly what all our clients need to do. And those people who are not our clients, who should become our clients because we're doing it better than everyone out there. So that is the mantra. Keep calm and carry on. We'll take care of the internal mechanics of how the portfolio is operated. And we're factoring in everything that's going on. I do, periodically I get emails from clients saying, what about this and what about that? And by the way, here's a news article from the digital media that I read, and it's scary and blah, blah, blah. As a market professional, we get live data. We know exactly what's going on all the time. There's nothing. An article in some journal is going to educate us on capital markets. So we know what's going on. We're making changes accordingly, and we believe we're going to have great success as we have had, and we will continue to have.
Absolutely. So for people who are listening to the podcast and they are not your client, and they may want to reach out to you all, what is the best way for them to contact you to perhaps start a conversation?
Best way would be for them to send us an email at info@medwealth.ca or visit our website, which is med-wealth.ca.
Very good. And if you are listening to this podcast and you're new, I would recommend you give them a call, but 2, hit the follow button. That's easy. Costs you nothing. Just hit the follow button, become a subscriber, because as a subscriber, you will automatically be notified when new episodes drop. You'll never miss another one ever again. Unless you choose to not listen. That'll be on you, not on us.
Bill, something we haven't discussed because we've been focused in on the conflict in the Middle East is what's going on between the U.S. and Canada in terms of the trading arrangements. As we all know, we have this free trade agreement that covers roughly 80 to 90% of the trade that occurs between Canada and the United States. And it's up for renewal this summer. And that free trade agreement can either be renewed with some modifications or it can be abandoned. And something that a lot of Canadians have not comprehended is that the magnitude of that free trade agreement on Canada's economy.
It's huge.
I read an article recently in the financial press here in Canada about the fact that roughly half of Canadians think that if this free trade agreement is not renewed, that it's no big deal. I'm here to tell my fellow Canadians it is a huge deal. That current free trade agreement covers, as I said, the majority of our trade between our two countries.
Oh.
And in as much as it's good to diversify your trading relationships with other countries, and I get all that, and I think that's a good thing to do. Due to our proximity, cultural similarities, and regional objectives between us and the United States, it's not so simple to cut bait and leave the pond. We cannot function economically in the short term without a free trade agreement with the U.S. It would be disastrous for our economy not to have access to the world's largest economy. So it is in our best interest as a nation. Yes, you can, like I said, go ahead, diversify your trading partners.
Yeah.
You should do that anyway, regardless of what's been happening the last few years. That should have been done a long time ago anyway. We should, a long time ago, have been exploiting our own resources. I read something recently that on a per capita basis, Canadians are standing on top of $800,000 in natural resources per person. As you know, in Saudi Arabia, they're standing on those residents are standing on an abundance of wealth. But unlike Saudi Arabia, we in Canada have chosen over the last decade not to exploit our resources to our economic benefit. And that's had a material negative impact on our economy. And we're seeing a reduction in our per capita standard of living over the last decade. And Canadians are rather passive about that reality. So, to be passive about the fact that this free trade agreement could go away in a matter of months from today, that would be horrific. You cannot diversify away from the United States over 6 months or a year. It would take decades to achieve that level of economic relationship with other organizations. And the decades from now, there will be no President Trump or Prime Minister Mark Carney. It'll be upon other representatives of Canada and the United States to deal with these issues, and other leaders around the world. So it is incredibly important that our leadership in this country find a way to come to terms with our neighbors to the south. Whether you like the current leadership or not is of no relevance. This is a business arrangement, and we need to get this done. And right now, our prime minister has been saying a lot of things, but I haven't seen anything done yet. So we need to get something done so we can ensure the viability of our economy, because we are a country that's wealthy in natural resources, wealthy in natural human capital, and we need to employ this wealth to our productive strength, and not sit idly by and watch our economy continue to deteriorate.
Well said. Well said. And speaking as the only American on this podcast, I hope we do get it done. And, I for one am hopeful that, in fact, senior heads will prevail, John. And, because it is in the best interest of both on the American side and the Canadian side. And so, we'll see what comes of it. But my expectation is that it's going to be renewed and reaffirmed, if you will. So
certainly hope so.
Me too. So that wraps us up for this episode. Gentlemen, do you know what you got coming ahead, or is it a wait and see kind of deal?
There's nothing currently on the docket right now, Bill, but we will be working on that in the coming days, and hopefully have some interesting guests to come on.
We do have podcasts that we've recorded that have not yet been released. Perhaps you want to touch on those. The podcast that we have, the one that has been recorded and has yet to be released, is going to be part 2 of the real estate discussion that you had with Mark Morris.
Ah, good. That was an interesting conversation. So I look forward to that. Absolutely. Okay, ladies and gentlemen, hit that follow button and tell people about the podcast. We'll catch you next time.
thank you for listening to Prescribing Prosperity. Visit our website at med-wealth.ca. That's med-wealth.ca for more information or to connect with us for a consultation. Don't forget to click the follow button to be notified when new episodes become available. The information covered and posted represents the views and opinions of the hosts and their guests and does not necessarily represent the views or opinions of ITC Securities Corporation. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investment advice. Always seek the advice of a qualified and licensed financial service provider with any questions you may have regarding your investment or retirement planning. MedWealth Financial Services can provide a private consultation to help you determine the suitability of any guidance discussed on the show.